The three outside down pattern is a significant formation in trading that traders and investors often look out for as an indicator of potential market movement. This pattern is identified through the examination of candlestick charts, a popular tool for visualizing price movements over time. The formation consists of three specific candlesticks, with the first being a large up candle within an uptrend, suggesting bullish sentiment. This is followed by a candle that opens higher but reverses and closes below the previous candle's close, indicating a shift in momentum. The third candle confirms the reversal, closing even lower and signaling bearish sentiment. This pattern is seen as a reliable indicator of a potential bearish continuation or reversal, depending on its context within the broader market trends. Understanding and identifying the three outside down pattern can be highly beneficial for traders. It provides crucial insights into market sentiment and potential shifts in trend, enabling traders to make more informed decisions. Practicing the identification and interpretation of this pattern within different market conditions can significantly enhance a trader's ability to anticipate and react to market movements. By developing this skill, traders can better time their entries and exits, manage risks, and optimize their trading strategies. It is also essential to recognize the dynamic nature of the financial markets. Continuous learning and adaptability are key to success in trading. Markets evolve and new patterns emerge, emphasizing the importance of ongoing education and the willingness to adapt strategies when necessary. The understanding of candlestick patterns like the three outside down is just one aspect of a comprehensive trading skill set. Traders should strive to build a diverse knowledge base that includes technical analysis, fundamental analysis, risk management, and psychological resilience. By committing to continuous learning and staying adaptable to market changes, traders can maintain their competitiveness and achieve long-term success in the trading world. Candlestick patterns are a cornerstone in technical analysis, offering a visual representation of price action and market sentiments during specific time intervals. These patterns derive from Japanese rice traders hundreds of years ago and have been a vital tool for traders and investors in predicting potential market movements based on past and present price actions. At the heart of candlestick patterns are the open, high, low, and close prices within a given time frame. The body of the candlestick reflects the opening and closing prices, while the wicks or shadows indicate the high and low prices during the period. Candlestick patterns can manifest as a single candlestick or a combination of multiple candlesticks, each conveying a unique storyline about the market's directional bias. Among these, the three stars in the south is a lesser-known but significant bullish reversal pattern that typically appears at the end of a downtrend. This pattern consists of three consecutive candlesticks, each closing lower than the previous one, but with smaller and smaller bodies, indicative of waning selling pressure. The first candlestick is large, reflecting strong selling pressure. The following two candlesticks show a gradual decrease in the size of the bodies, hinting at a reduction in bearish momentum and the potential for a bullish turnaround. Understanding the three stars in the south requires recognizing its formation against the backdrop of a prevailing downtrend, signaling a weakening of the bearish trend and suggesting a potential reversal to the upside. This makes it a powerful tool for investors looking for signs of a market bottom and the beginning of a bullish trend. However, like all technical patterns, it should not be used in isolation. Traders often seek confirmation from additional indicators or subsequent price movements to validate the reversal signal presented by the three stars in the south pattern. The three stars in the south is a candlestick pattern in technical analysis that signals a potential bullish reversal. It is identified by a sequence of three consecutive long-bodied candlesticks that appear during a downtrend. Each candlestick in this pattern opens within the body of the previous candle and closes at a lower price than it opened, suggesting a weakening of the downtrend. To visualize the appearance of the three stars in the south without actual imagery, imagine looking at a financial chart. You notice the market has been in a downtrend characterized by falling prices. Suddenly, a long bearish candle appears, indicating that the price has moved significantly lower from open to close. On the next day, another candle appears with a similar but slightly smaller body, and it opens within the body of the previous day's candle but still closes lower. Finally, on the third day, you observe a similar candlestick, which also opens within the body of the preceding day's candle and closes lower, but its length is shorter than the second candlestick. This formation of candles suggests exhaustion in the ongoing downtrend and hints at a potential reversal, meaning prices might start to rise. The three stars in the south is relatively rare, but considered a reliable indicator of a bullish reversal when it does appear. It tells traders and investors that the selling pressure is decreasing and that the market sentiment may be shifting from bearish to bullish. Observing this pattern can provide an opportunity to enter the market early in anticipation of a reversal in the trend, potentially leading to favorable returns. It is important, however, to look for confirmation of the trend reversal through other indicators or a successive increase in prices to validate the bullish signal provided by the three stars in the south pattern. Identifying the three stars in the south requires attention to its unique features. This pattern is composed of three consecutive candlesticks, each with a specific shape, size, color, and arrangement. The first candlestick is the longest and bearish, signaling the continuation of a downtrend. It is followed by two smaller bearish candlesticks, each opening within the body of the preceding candle but closing higher, indicating a weakening of the bearish momentum. The color of all three candlesticks is typically black or red, representing a closing price lower than the opening price for that day. The size of each candlestick diminishes from the first to the third, reflecting a decrease in selling pressure and potentially hinting at a reversal. The arrangement of the candles, with each subsequent candle opening within the body of the previous one but closing slightly higher, suggests a gradual shift in market sentiment from bearish to less bearish or neutral. The pattern's position within a downtrend is crucial for its accurate interpretation. It signals the possible end of a downtrend and the beginning of a bullish reversal. This interpretation is strengthened when the pattern forms after a significant decline, indicating that sellers are losing control and buyers may be starting to step in. For a clearer understanding, one could look at chart examples from past market activities. Visualizing this pattern in different market conditions would show it appearing after a noticeable downtrend, with each of the three stars candlesticks standing out due to their distinct size, shape, and arrangement. These real instances help in studying the pattern's effectiveness and its potential to forecast a bullish reversal, providing valuable insights for trading and investment strategies. The three stars in the south is a candlestick pattern that suggests a shift in market sentiment from bearish to bullish, indicating a possible end to a bearish trend. This pattern consists of 3 consecutive long-bodied candlesticks that open within the body of the previous candle and close at a lower level, with each succeeding candle opening and closing progressively higher than the previous one. This formation reflects a weakening of the downward momentum and suggests that sellers are losing control while buyers are beginning to dominate, leading to a potential reversal in price direction. Initially, the presence of long-bodied candlesticks in a downtrend signifies the bearish sentiment. However, the gradual increase in the closing prices each day indicates a shift in trader psychology. Investors interpret this as increasing bullish sentiment, where demand is starting to outpace supply, suggesting that the bearish trend may be exhausting itself. Moreover, the pattern's appearance after a significant downtrend serves as a signal to traders that the selling pressure is diminishing and a change in trend could be imminent. The 3 stars in the south pattern plays a critical role in technical analysis by highlighting a gradual but significant shift in momentum from bearish to bullish. This transition is key for traders who are looking to capitalize on entering early in a new bullish trend. By understanding the underlying market sentiment and psychology that this pattern signifies, investors can make more informed decisions about their trading strategies, potentially leading to enhanced market timing and improved investment returns. The 3 stars in the south is a candlestick pattern often viewed by technical analysts as a potential sign of a bullish reversal. This means it suggests that a current downtrend in the market might be nearing its end, and an uptrend could be on the horizon. However, like many patterns in technical analysis, its interpretation depends heavily on the broader market context in which it appears. Let's break down the pattern for clarity. Imagine you're looking at a price chart and you notice 3 consecutive long-bodied candles, each closing lower than the previous one, but with smaller and smaller bodies. This formation suggests a weakening of the downward momentum, potentially signaling that bears are losing control and a bullish reversal might follow. However, it's crucial to understand that the 3 stars in the south, while suggestive of a potential reversal, does not guarantee it. Analysts would typically look for confirmation in the form of a bullish candle following the pattern or other indicators aligning with a reversal scenario. To illustrate, consider a chart where, after a prolonged downtrend indicated by a series of lower lows, you spot the 3 stars in the south pattern. If this pattern is followed by a significant bullish candle and perhaps coincides with a key support level, it boosts the confidence in interpreting it as a bullish reversal signal. On the other hand, if the market context shows strong bearish momentum overall, without clear signs of weakening, or if the pattern forms in a less significant position, its predictive power may be weaker. It's akin to finding a sign of spring during a cold winter day. One needs more evidence before confidently declaring the change of seasons. It's also worth noting that while this pattern is potentially indicative of a bullish reversal, it doesn't serve as a continuation pattern. A continuation pattern would suggest the current trend is likely to persist, which is not what the 3 stars in the south inherently signals. To sum up, the 3 stars in the south is a nuanced and context-dependent pattern. While it can hint at a bullish reversal after a downtrend, its reliability heavily relies on the broader market conditions and subsequent price action for confirmation. Investors often combine this pattern with other analysis techniques to make more informed decisions. To understand the three stars in the south pattern and its significance in the financial markets, it is essential to pay attention to additional indicators and conditions like trading volume, nearby support levels, and the trend preceding the pattern. These factors play a critical role in validating the implications of this bullish reversal pattern. First, trading volume is a crucial indicator. For the three stars in the south pattern to be considered valid, an increase in trading volume on the days following the formation is often seen as a positive sign. This suggests that buyers are entering the market, providing the necessary momentum for a potential upward trend. Second, nearby support levels are also important to consider. Support levels are prices at which a financial asset has shown difficulty falling below in the past. A three stars in the south pattern that forms near a known support level can be more significant because the support level can act as a safety net, providing confidence to investors that the asset price is unlikely to fall further. Lastly, the trend preceding the pattern is vital to examine. Typically, the three stars in the south appears after a downtrend, indicating a potential reversal. If this pattern emerges during a downtrend, it can be seen as a stronger bullish signal. However, if the pattern forms without a clear prior downtrend, its significance might be questionable. In summary, while the three stars in the south is a strong indication of a potential bullish reversal on its own, factors such as increasing trading volume, the proximity to support levels, and the presence of a preceding downtrend can reinforce or weaken the pattern's significance. Paying attention to these conditions can provide investors with a more comprehensive understanding of the market situation and the pattern's reliability. The three stars in the south is recognized as a bullish reversal pattern found in candlestick charting, often signaling the end of a downtrend and the potential onset of an uptrend. It is composed of three candles, each with a smaller body than the last, forming a staircase-like descent. This pattern has historically had a noteworthy level of accuracy in predicting changes in market direction. However, like all technical analysis tools, it is essential to understand its limitations. The pattern's reliability can be influenced by market volatility, the presence of other conflicting signals, and the broader economic context. Therefore, it should not be used in isolation. Employing it alongside other analytical tools, such as moving averages or relative strength index indicators, can provide a more comprehensive view of the market direction. This approach allows investors to cross-verify signals and make more informed decisions by considering multiple data points, thereby increasing the chances of successful investment outcomes. In summary, while the three stars in the south has been effective in forecasting market direction changes, investors should remain aware of its limitations and the importance of combining it with other technical analysis tools for better accuracy. Integrating the three stars in the south pattern with other technical analysis tools such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, or Fibonacci retracements can enhance trading decision-making by providing multiple confirmation signals and a more comprehensive market analysis. To combine the three stars in the south pattern with the RSI, traders can look for conditions where the RSI indicates the market is in an oversold condition shortly after the pattern appears. This serves as an additional confirmation that the current downtrend may be weakening and a bullish reversal could be imminent. Using the MACD in conjunction with the 3 stars in the south pattern involves observing the MACD line for a bullish crossover, where the MACD line crosses above the signal line, sometimes close to or after the pattern's completion. This crossover can signal that momentum is shifting from bearish to bullish, reinforcing the reversal signal indicated by the pattern. Incorporating Fibonacci retracements involves identifying potential support levels after a market downtrend that leads into the 3 stars in the south pattern. If the pattern forms around a significant Fibonacci retracement level, such as 61.8%, it may indicate a strong area of support and a higher likelihood of a bullish reversal. For example, imagine a scenario in the stock market where a trader identifies the 3 stars in the south pattern on the daily chart of a company's stock that has been in a downtrend. Upon checking the RSI, they find it is below 30, indicating the stock is oversold. Additionally, the MACD shows a recent bullish crossover. The trader also notices that the pattern has formed near the 61.8% Fibonacci retracement level from the last major rally. Together, these indicators provide a stronger conviction that a bullish reversal is likely, thus informing the trader's decision to enter a long position in anticipation of the uptrend. By using these complementary technical analysis tools in harmony with the 3 stars in the south pattern, traders can make more informed decisions, potentially leading to improved outcomes in their trading strategies. Traders often encounter errors and misconceptions when interpreting the 3 stars in the south pattern, a bullish reversal indicator in candlestick charting. Recognizing and mitigating common mistakes can significantly enhance one's pattern recognition and analytical skills. One common mistake is misidentifying the pattern due to a lack of understanding of its unique characteristics. The 3 stars in the south should consist of 3 consecutive long-bodied black or red candles, each with a lower close than the previous candle and a smaller shadow indicating a decline. A failure to identify these precise traits can lead to incorrect assumptions about market direction. Another error is ignoring the context in which the pattern appears. This pattern is meaningful after a sustained downtrend. Recognizing it in the wrong market context diminishes its predictive power. It's crucial to look at preceding price action to confirm the presence of a downtrend before considering the implications of this pattern. Traders might also overly rely on this pattern alone without considering other indicators. It is essential to use the 3 stars in the south in conjunction with other technical analysis tools. Support and resistance levels, volume analysis, and other candlestick patterns can provide additional confirmation and increase the reliability of the signal. To avoid these mistakes, traders should 1. Thoroughly study the pattern's characteristics and practice identifying it within various chart contexts. Training one's eye to notice the nuances of candlestick patterns can significantly improve accuracy. 2. Always evaluate the broader market context before drawing conclusions based on specific patterns. Understanding the overall trend can help traders use the 3 stars in the south more effectively. 3. Employ a holistic approach to technical analysis. By combining multiple analysis methods, traders can filter out false signals and increase their confidence in the generated signals. Improving pattern recognition and analytical skills requires time, practice, and a commitment to ongoing learning. By recognizing common pitfalls and rigorously applying analytical methods, traders can enhance their ability to navigate the complexities of the financial markets. The 3 stars in the south is a bullish reversal pattern that appears in candlestick charts, signifying a potential shift from a downward to an upward trend. Understanding and utilizing this pattern for trading decisions involves recognizing the formation and strategically setting entry and exit points. To employ the 3 stars in the south pattern in trading decisions, one should first identify the configuration in a declining market. The pattern comprises 3 consecutive long-bodied candlesticks that make lower lows, each closing within the body of the previous candle. Although the candles continue the downward trend, they signal a loss of momentum in selling pressure, hinting at a potential reversal to an uptrend. For entry points, traders usually wait for confirmation of the reversal trend following the appearance of the 3 stars in the south pattern. This confirmation may come in the form of a bullish candlestick breaking above the 3rd candle's high or other technical indicators signaling an uptrend. Setting a stop loss slightly below the lowest point of the 3rd candle helps manage risk if the expected upward movement does not materialize. Exit points should be determined based on the trader's risk tolerance and overall trading strategy. Some traders may set a profit target at a previous resistance level or use trailing stop losses to maximize potential gains while protecting against a reversal in the market direction. A case study illustrating the effective use of the 3 stars in the south involves a trader who spotted the pattern in the chart of a technology stock that had been in a downtrend. Upon observing the pattern, the trader waited for additional bullish confirmation, which appeared as a large bullish engulfing candlestick shortly after the 3rd star. The trader entered a long position at the open of the next day, with a stop loss set below the lowest point of the 3rd candle in the pattern. As anticipated, the stock's price began to rise, allowing the trader to adjust the stop loss upward progressively and eventually exit the position at a significant profit near a key resistance level that was identified prior to entering the trade. This example underscores the importance of patience, confirmation, and predefined risk management strategies when trading based on candlestick patterns like the 3 stars in the south. The 3 stars in the south is a bullish reversal pattern found in financial markets, which signals a potential upward movement in the price of an asset. This pattern consists of 3 consecutive candlesticks that exhibit specific characteristics. However, there are variations of this pattern and similar patterns that traders and analysts use to gauge market sentiment. Let us explore some of these variations and how they differ in interpretation. One variation is known as the morning star. The morning star pattern also signifies a bullish reversal, but differs in its structure. It consists of 3 candlesticks. A long bearish candle followed by a small candle or a doji that indicates indecision, and then a long bullish candle that closes well into the first candle's body. This pattern suggests that the bulls have taken control of the market from the bears. Another pattern akin to the 3 stars in the south is the inverted hammer. Unlike the 3 stars, which is spread over 3 candlesticks, the inverted hammer is a single candlestick pattern that appears at the bottom of a downtrend. It has a small body at the lower end and a long upper wick, signifying that buyers attempted to push the price up, but significant selling pressure still exists. A bullish movement following this pattern confirms a potential trend reversal. The bullish engulfing pattern is also comparable and indicates a reversal. It consists of two candlesticks, with the second engulfing the body of the first. The first is a smaller bearish candlestick, and the second is a larger bullish candlestick. This pattern reflects a strong shift in momentum from sellers to buyers. When analyzing these patterns, traders often look at the size of the candlesticks, the volume accompanying the pattern, and the context within market trends. For instance, a 3 stars in the south pattern that occurs after a prolonged downtrend and is supported by increasing volume provides a stronger signal than the same pattern in a less clear context. In describing these patterns without illustrative charts, imagine the transition from a period of market pessimism, where price steadily declines, to a moment where signs of hope or indecision appear, shown by smaller or differently structured candles. Finally, a clear bullish signal emerges as buyers gain confidence and start pushing prices upward, portrayed by longer bullish candles or specific pattern completions. It is crucial for traders to use these patterns in conjunction with other technical analysis tools and fundamental analysis to enhance the accuracy of their predictions and manage risk effectively.